Okay, let's unpack this. We are jumping into, well, centuries of financial history today, really trying to explore why crises feel like they're kind of on repeat sometimes.
Yeah, and we're leaning heavily on this truly massive piece of research. This time is different. 8 centuries of financial folly by Carmen Reinhardt and Kenneth Rogoff. It's quite something.
It really is a monumental effort, right? Pulling data from everywhere, medieval defaults up to, well, the 2008 crisis.
Exactly, and it fundamentally changes how you might think about stability, in the financial world. It suggests maybe stability isn't the default setting.
So our mission here is to kind of cut through all that density, pull out the really important bits, the surprises, the core ideas from this huge data set.
Basically give you a shortcut to being genuinely well-informed on these patterns of financial crisis without reading all 800 years worth of data yourself.
Exactly. And we'll be looking at the different kinds they talk about: government defaults, banking crises, currency crashes, inflation spirals.
Right, across all sorts of economies, advanced, emerging, the whole sweep of history.
And they take things off by being really, really precise about what they're even counting. Defining a crisis is step one, seems like.
Absolutely. You can't count them if you don't agree on what one is, right?
Mm.
So they set these clear thresholds, quantitative where possible.
Okay, like what?
Well, for inflation, post-World War II, they said 40% annual inflation or more. That's a crisis. Before World War II, when inflation was generally lower, the bar was 15%.
Makes sense. And currency crashes?
Similar idea. Post-WWII, a 25% drop in value in a year. Pre-WWII, again, a bit lower, 15%.
In banking crises? That sounds harder to just put a number on.
It is. Especially historically, getting consistent data like bank stock prices across countries is, well, basically impossible for long stretches. So they define it more by events.
Events like?
Widespread bank runs, lots of failures, maybe forced mergers or big government bailout, things that signal the whole system is under stress.
Gotcha. And then, of course, the big one they focus on a lot: sovereign debt default. Governments not paying their debts.
Right, whether that debt is owed externally to foreigners or domestically to their own people or institutions. And finding data on that over 800 years.
Wow.
Sounds like a nightmare.
They talk about it, the huge challenge, especially with government debt. Historically, it wasn't exactly transparent. Finding reliable records, particularly for that internal domestic debt, notoriously tough.
Okay, let's stick with that sovereign default piece for a minute, because the sheer frequency they found, that's maybe one of the most striking things in the whole book.
It really is. The key takeaway, I think, is that default is not some rare freak event. It's not just for a handful of unstable countries. Their data paints it as a recurring, almost normal feature of history.
Across regions, across centuries.
Exactly. Stability, where governments always pay their debts, that actually looks like the historical exception, not the rule. Get this, France. Not exactly a minor player, right? They defaulted 8 times just between the mid-1500s and the French Revolution. 8 times.
And Spain. Spain managed 6 defaults before 1800 and then another 7 in the 19th century. That's what, 13 defaults?
It's kind of mind-boggling.
And they mentioned countries like Greece and Austria basically spent huge chunks of their history in a state of near constant default.
And it's not just a European story either, is it?
No, not at all. The research really pushes back on this idea that, say, post-colonial nations in Asia and Africa mostly avoided this. They have significant default histories, too.
So that recent period, maybe like the mid-2000s, where things seemed relatively stable on the government debt front globally.
That looks really unusual against the long backdrop, the 2003-2008 period, for instance. Very much not the historical pattern. It's easy to get lulled into thinking default is this distant memory, but it's deeply woven into financial history.
Okay, and they're digging into sovereign debt a bit more. There's one part the authors really highlight, something they say has been kind of ignored by modern economists and policymakers.
Ah, yes. Domestic public debt.
Exactly. The money governments owe internally to their own citizens or banks.
Yeah, this is a really crucial point they make. It's been overlooked, maybe because the data is harder to find, maybe because after World War II, the big international crises often seem to be about external debt owed to, foreign banks or the IMF.
But their research says this domestic debt has always been incredibly important.
Hugely significant, historically. And they argue that understanding it is actually key to figuring out some historical puzzles, like episodes of really high inflation or defaults that didn't quite fit the usual external debt story.
Right. So how common is domestic default? Is it as common as external?
Less common, but as they put it, hardly rare. Their data finds over 70 cases of overt legal domestic defaults since 1800. Compare that to about 250 external defaults. So less frequent, but still, happens quite a bit.
And defaulting domestically, it's not always just saying we won't pay. Right. It can be sneakier.
Oh, yeah, definitely. It can be things like forcing people to convert their bank deposits from, say, dollars into the local currency at a really bad rate.
Hmm.
Or the government just deciding to pay lower interest rates than promised.
Or cutting the principal owed, or just stopping payments.
Exactly. All sorts of ways to effectively default on your internal obligations.
But wait, if a government owes money in its own currency, why would it ever default? Couldn't it just print more money and inflate the debt away? That seems easier.
That's the common assumption, isn't it? But the authors point out that high inflation itself is really damaging. It causes huge distortions, messes up the banking sector, the whole financial system.
So sometimes default is seen as the lesser evil.
Sometimes, yeah. Especially if the debt is very short term, you'd need insane hyperinflation levels to make a real dent quickly. Or if the debt is indexed, say, to inflation itself or to a foreign currency, then inflating doesn't help you as much.
Ah, okay. Is there a historical example?
Well, they mentioned the U.S. in 1933 abrogating the gold clause in government bonds. Those bonds promised payment in gold, a domestic commitment. The government basically said, nope, we can't do that anymore, an effective domestic default.
Interesting. And do domestic debt crises look different in the data in terms of their impact?
They do seem to.
Yeah.
They're associated with much, much higher inflation in the year of the crisis. The average they found was something like 170% inflation.
Wow. Compared to what for external defaults?
Compared to about 33% for external, so way higher. And the initial hit to real GDP, the economic contraction, also seems to be worse in domestic default episodes. It suggests that internal shock really ripples through the system badly.
And wasn't there a case in Mexico that kind of brought this issue to light more recently?
Yeah, the Tesobonos crisis in 94, 95. These were government bonds linked to the U.S. dollar, which sounds like external debt, right? But crucially, they were issued domestically under Mexican law.
Ah, so when they ran into trouble, it highlighted this risk of foreign currency debt held inside the country.
Exactly. It looked a lot like a classic external debt crisis in some ways, but it was technically domestic. It was a bit of a wake-up call, though they note that major international bodies were still pretty slow to focus on domestic debt risks, even after that.
Okay, shifting gears slightly from governments not paying, let's talk about banks. Banking crises are another recurring theme, right?
Oh, absolutely. And the authors stress this fundamental vulnerability that's just, well, built into the banking model.
You mean the whole maturity transformation thing?
Just precisely that. Banks borrow short-term. Think about your checking account. You can pull that money out anytime. But they lend long-term 30-year mortgages, business loans that won't be repaid for years.
So there's always that mismatch.
Always. And if confidence suddenly evaporates and lots of people want their short-term deposits back now, that's a bank run.
And the bank can't just call in all those long-term loans instantly.
Nope. They have to start selling assets fast. Maybe those loans, maybe securities they hold, and they often have to sell them at fire sale prices, way below what they're actually worth.
Which can sink an individual bank.
Right. But during a systemic crisis, when many banks are in trouble at once, and they're all trying to sell similar assets, the market for those assets can just freeze up or collapse entirely. It becomes a system-wide meltdown.
And historically, people used to think of severe banking crises as like an old problem for rich countries before World War II, or maybe an emerging market issue afterwards.
That was kind of the thinking, yeah. But then 2007, 2008 happened, starting in the U.S., spreading everywhere.
And as the authors say, that really dashed this misconception.
Completely. Showed these deep, costly banking crises can absolutely hit major advanced economies. Anywhere, really.
And their data connects banking crises to other problems, too.
Yes, there's a strong historical link. Periods with lots of global banking crises often overlap with periods of high sovereign external defaults. They seem to kind of feed off each other.
And what about asset prices? Bubbles.
Deeply linked. Banking crises are very often preceded by these huge surges of capital flowing into a country. They call them capital flow bonanzas. And they're typically followed by really prolonged collapses in asset prices, especially housing.
Ah, the housing market connection. What did their data show there?
It's pretty stark. In major post-WWII banking crises associated with housing busts, the average real house price decline was 35%. And that downturn didn't happen quickly. It stretched out over, on average, 6 years.
6 years? That's a long, slow bleed.
Much slower and more painful, typically, than what happens in the stock market. Equity prices tend to fall much more sharply in a crisis, maybe 55, 56% on average, but they often recover faster, more like 3.5 years. More of a V-shape compared to housing's L-shape or U-shape.
Okay, this feels like a good point to bring up the central theme that runs through their entire book, maybe the most important takeaway. This time is different syndrome.
Yes, this is absolutely core to their argument. It's this recurring belief, this kind of collective delusion that pops up again and again across centuries and countries.
The belief that this time, because of some new factor, a new technology, a new financial product, maybe smarter policy, maybe just recent good luck.
The old rules of debt and risk just don't apply anymore.
Exactly that. It's the mechanism of denial that allows booms and leverage to build up to unsustainable
And
levels.
the book is just packed with examples, right?
Oh, completely. Think about the run-up to the Asian crisis in the 90s. The narrative then was all about how different these economies were. Conservative finances, stable currencies, high growth, high savings. No recent memory of crisis.
And therefore immune.
That was the implication, until it all came crashing down. Or go way back, like the 1820s lending boom to newly independent Latin America.
What was the story then?
Pure euphoria, almost. Silver fever, talk of irrational exuberance. The idea was this was a new world with endless potential, so the old risks didn't matter. Again, until the defaults started rolling in.
And the most recent, maybe most painful example for many listeners would be the lead up to the U.S. subprime crisis, starting around 2007. What were people saying then about why this time was different? Oh, there was a whole list. A big one was faith in superior U.S. institutions, especially the Federal Reserve. The idea of the Greenspan put, that the Fed would always step in to rescue markets.
Right. What else?
Confidence in new financial engineering, securitization, packaging up mortgages and selling them off. The idea was this made housing debt safer, more liquid, spread the risk widely.
So widely, no one knew where it really was.
Well, that turned out to be the problem, didn't it? Plus, general enthusiasm about financial globalization, innovation, productivity gains, justifying high asset prices. It all fed into this narrative that the U.S. system was uniquely resilient.
And the authors see a direct parallel here with how emerging markets often behave during booms.
Exactly. Governments, investors, everyone gets caught up, assumes the good times, the capital inflows, the rising prices will just go on forever because, well, this time is different, and they fail to take basic precautions.
Although it's fair to say not everyone was buying it before 2007, right? There were warning signs, some people raising alarms.
Absolutely. They mentioned folks like Nouriel Roubini, Brad Setzer, Paul Krugman, who were pointing to, for instance, the unsustainability of U.S. borrowing, the massive current account deficits, and critically, the housing bubble being inflated by this huge run-up in household debt.
That debt-to-income ratio really spiked.
It really did, which contrasted sharply with the more optimistic views that saw deficits as fine, or argued against the Fed intervening in housing prices because, markets are efficient.
But as history showed again, this time wasn't different.
Nope, proven wrong again, and the cost was immense.
And when these severe crises do hit the aftermath, the data shows it's usually not a quick recovery. It's often long and painful.
Yeah, their historical analysis paints a grim picture of the typical aftermath. We mentioned the housing price collapse down 35% over 6 years on average. Equity markets fall even further initially, like 56%, though they tend to bounce back quicker, maybe 3.5 years.
And the real economy, output, jobs.
Big hits there, too. In the severe crises they studied, real GDP per person falls by an average of 9.3%. That's a deep recession or depression.
Ouch. And unemployment obviously goes up. What about government debt?
That explodes. As governments step in to bail out banks, support the economy, and just because tax revenues collapse, real public debt shoots up by an average of 86% in the 3 years following a major crisis. 86%.
Wow. And were crises always this bad, or were some periods worse than others?
They do find differences.
Yeah.
The crises associated with the Great Depression in the 1930s seem to have been, on average, even more traumatic than the big ones after World War II.
How so?
Recovery took much longer. For the countries in their Great Depression sample, it took an average of 10 years just for real income per person to get back to where it was before the crisis hit.
Yeah.
10 years. Post-WWII recoveries, while still painful, tended to be faster than that.
Okay. And one final pattern they highlight, crises like to hang out together.
Yeah, they tend to cluster. You see it both within a country, like a currency crash might lead to a banking crisis, which could trigger inflation or even a default. One problem spills into another.
And across countries too. Contagion.
Exactly. Financial fragility spreads. Trouble in one country can easily spark problems in others. especially in today's interconnected world, but even historically.
So if we step back and try to absorb all this deep dive into 800 years, the big message from Reinhardt and Rogoff really seems to be that crises aren't the anomaly. They're not black swans, not relics of the past.
No, they seem almost baked into the system. Debt defaults, banking panics, currency collapses, inflation surges. In one form or another, they are a persistent, maybe inherent feature of market economies across the centuries.
And just pointing to new gadgets, new policies, new institutions, that's rarely enough to actually break the cycle.
Their work suggests profound skepticism about that. The core vulnerabilities, especially around debt and leverage, tend to remain. And maybe relying too much on one policy tool like just targeting inflation while letting leverage run wild elsewhere in the system. That seems to be part of the recurring trap.
That this time is different syndrome is just so powerful. The historical evidence they lay out is this massive counterweight to that very human tendency to believe that this boom, our boom, is built on something fundamentally new and solid.
Right. They're deeply skeptical that these cycles just end on their own, or that we've somehow permanently conquered risk. The patterns of boom, bust, debt, and denial are just too deeply rooted in this long history they've uncovered.
So thinking about this incredible sweep of history, 800 years of recurring crises, and this persistent human habit of thinking this time is different, it leaves you wondering, what's the single most important lesson you take away from all this about how to maybe spot vulnerability, real vulnerability in financial systems today?